They never ring an alarm before a collapse. They never warn their employees. They never look nervous in interviews or tremble in board meetings. But behind the calm smiles and carefully rehearsed statements, something else is happening. Something most people will never see. Something that has quietly destroyed thousands of careers, wiped out billions in retirement savings, and turned loyal employees into collateral damage. It begins not with a crash, but with a signature, a simple click, a form submitted, a CEO cashing out millions in stock while telling the world everything is fine. Imagine this. It's Thursday morning. A senior analyst at a major bank walks into his office like any other day. HES spent the last 10 years there. He trusts his CEO. He believes in the company. HES got half his retirement savings in the bank stock because, after all, why not invest in your own future? But down the hall, behind a door with frosted glass, his CEO is doing the exact opposite. Quietly dumping shares, quietly setting up a 10b5-1 plan that insiders always use, quietly cashing out millions just weeks, sometimes days, before everything collapses. And when the crash finally comes, the employees watch their savings evaporate, while the CEO walks away untouched. This isn't a conspiracy theory. This is a pattern, a documented pattern that repeats itself over and over again. It happened in 2008, it happened in 2023, and based on new filings, it's happening again right now. Most people don't know the signs: a sudden insider sale disguised as a pre-planned trade, a suspicious earnings call filled with reassurances that liquidity is strong, a debt report buried in a PDF none of the employees ever bother to read. But the executives know. They can see the internal numbers. They know when deposits are leaving. They know when liquidity breaks. They know when the loan book is turning poisonous. And instead of fixing it, they run. Think back to one of the most shocking cases in modern banking. A CEO who sold nearly $4 million in stock just days before his bank imploded. Employees found out from the news. They had no warning. One junior manager said she lost her entire life savings, money she had been setting aside for her daughter's college. But when reporters asked the CEO whether he felt responsible, he simply replied, "The sale was part of a pre-approved trading plan." A perfectly legal sentence, a devastatingly convenient one. And that's the trick. Most of this is legal. The timing is the magic. The timing is the weapon, and the timing is never in your favor. This is where the real story begins, not with the collapse, but with the silence before it. Because every collapse, no matter how sudden it looks from the outside, has warning signs on the inside. A liquidity desk that suddenly stops sharing data, a treasury officer quietly rewriting internal guidelines, a risk manager who resigns without explanation. Employees notice these things in pieces, but they never connect the dots. They can't. They don't have the full picture. But the CEO does. He sees the whole storm forming. He sees the bank bleeding from the inside. And while everyone else waits for the quarterly report, he prepares his exit. Picture another employee, a mid-level loan officer. He joined right out of college. He bought the company stock every month through the bank's employee investment plan because everyone told him it was the safest place to build long-term wealth. Companies even market it that way. Grow with us. Believe in us. But the CEO? The CEO believed in something else. He believed in protecting himself first. So he sold millions, quietly, legally, strategically. And when the bank failed, the employee looked at his account and saw a number so low he thought it was a glitch. It wasn't. But why does this pattern repeat? Why doesn't anything change? Why do we keep seeing the same cycle, the same denials, the same last-minute insider sales? Because the rules are written by the same people who benefit from exploiting them. Because the system rewards those who exit early and punishes those who stay loyal. Because when a bank is about to collapse, the first people who know are the executives, and the last people who know are the employees whose futures depend on it. Let's step back for a moment. Look at history. Look at 2008, a year that rewired how millions of Americans trust the financial system. Days before Lehman Brothers collapsed, insiders were quietly moving money. Executives cashed out bonuses. Some walked away with millions while ordinary employees were left with nothing. One former employee said she found out the company was finished when she saw people carrying boxes down the hallway. She didn't even know she had lost her job until her badge stopped working an hour later. Now fast forward to 2023, a bank with a 40-year history, a CEO who told the world everything was fine, a sudden insider sale that no one noticed until it was too late, depositors panicking, employees receiving emails at midnight telling them the bank was being seized. And the CEO? He had already moved his money, he had already resigned, he had already protected himself. This isn't just history. This is a blueprint repeating itself in 2024, 2025, and beyond. Because every time interest rates rise sharply, every time commercial real estate weakens, every time liquidity dries up, some banks quietly start drowning. And when they do, executives start selling. They don't have to say anything publicly. They don't have to warn their employees. They don't have to reveal internal risk assessments. All they have to do is file the right form at the right time with the right lawyer, and they get out before the collapse hits. Meanwhile, employees sit in town hall meetings listening to executives reassure them everything is stable, strong, and well capitalized. But behind those words are emails, spreadsheets, and internal memos telling a very different story. A story employees will never see until it's too late. And this is the part nobody talks about, the emotional toll. Because financial collapse isn't just about numbers. It's about lives, dreams, families. Imagine the feeling of opening your retirement account and seeing 30 years of savings gone in a single day. Imagine telling your spouse you don't know how you're going to pay the mortgage next month. Imagine trying to explain to your kids why you suddenly don't have a job. This is what employees face. Not the CEOs who sold early, not the executives who walked away with bonuses, not the board members who protected themselves. The employees, the people who believed in the company, the people who stayed loyal. But here is the real question. Why do CEOs always get away with it? Why does the system allow them to sell millions just before disaster? The answer lies in a loophole known as the 10b5-1 trading plan, a system created to prevent insider trading but now used as a shield to make it look like executives are selling automatically. But the secret? They can schedule those automatic trades right after seeing internal data the public doesn't know about. They can adjust the plans, cancel them, rewrite them, execute them days before a collapse. And once the crash happens, they simply point to the plan and say, it was pre-scheduled, nothing suspicious. This is how they hide. This is how they escape. This is how they sell millions while employees lose everything. But something else is happening, something new. Regulators don't talk about it. Media barely covers it. But if you pay attention to SEC filings, you'll see a pattern forming again. Rising insider sales at mid-size regional banks. Executives quietly reducing their exposure, CEOs selling near 10-year highs, CFOs trimming positions while publicly claiming the balance sheet is stronger than ever. It's the same script, the same movie, the same ending. And while employees continue buying stock through payroll deductions, hoping it will grow, the insiders are doing the opposite. They're leaving, quietly, quickly, strategically. There was one employee recently laid off who said something heartbreaking. I didn't lose my job, he said. I lost my future. That's what these collapses do. They don't just erase stock, they erase time, years of work, years of planning, years of saving. This is why understanding the patterns matters. Because if you can recognize the signs before the collapse hits, you can protect yourself. You can avoid being blindsided. You can move before the insiders move. And that's why channels like this exist, to reveal what you are not supposed to see, to show you the patterns CEOs hope you ignore, to help you understand how the next financial shock emerges long before the news ever reports it. So if you haven't already, subscribe to understand when the next financial shock hits, because the earlier you see the signs, the better your chances of staying safe. This isn't financial advice. It's survival advice, the kind no CEO will ever give you. Now let's go deeper into the psychology behind these collapses. Because CEOs don't panic the way you think they do. Their fear isn't sudden, it builds, quietly, slowly, from numbers no one else sees. When a large corporate client unexpectedly pulls out deposits, the CEO sees it. When credit losses begin creeping upward month after month, the CEO sees it. When the internal stress tests suddenly show red zones, the CEO sees it. And when their own chief risk officer sends a memo warning that liquidity could fail within months, the CEO sees it. And that's usually the moment they place the trade. That's the moment they decide to protect themselves. Employees have no idea any of this is happening. They only see the surface, free snacks in the office kitchen, motivational posters, a CEO sending cheerful emails about innovation and growth. But behind that smile is fear, the kind of fear only insiders feel when they know something is collapsing from the inside out. So they sell before collapse. Because they can. Because the system lets them. One former executive anonymously admitted something chilling. He said, if the ship is sinking, the captain should go down with it, but we're not captains. We're passengers with better access to the lifeboats. That sentence says everything. Employees don't get lifeboats. Employees get told to trust leadership. Employees get told to stay committed. Employees get told everything is under control. But it's never under control. And here's where modern technology makes things even more dangerous. Because collapses happen much faster now. Social media speeds panic. Digital banking accelerates withdrawals. A rumor can wipe out billions in deposits in hours. So imagine a CEO who knows the bank is weak. He knows one bad headline could trigger a bank run. He knows a single viral tweet could destroy the institution overnight. What does he do? Wait and hope? Or sell early? We already know the answer. And so the employees remain in the dark. Not because they're blind, but because the information is deliberately kept from them. A treasury report marked internal only. A liquidity memo marked confidential. A stress test marked not for distribution. These documents never reach the people whose entire livelihoods depend on the bank staying alive. And when the collapse finally happens, the CEO doesn't lose sleep. He doesn't lose the house. He doesn't lose the retirement fund. The employees do, every time. One retired bank teller in California shared her story years after her bank collapsed. She had spent over 30 years working at the same branch. She loved the job. She loved the customers. She trusted the institution. She invested in its stock religiously for decades. When the collapse came, she lost everything. Her entire retirement evaporated. She had to move into a smaller apartment. She had to cancel plans to help her granddaughter with college. And through tears, she said something heartbreaking. I thought the people running the bank cared about us. They didn't. They cared about themselves. And when trouble came, they saved themselves first. This is not an isolated tragedy. This is how the system is designed. CEOs are incentivized to maximize short-term stock price. Employees are encouraged to hold long-term shares. CEOs receive bonuses for performance. Employees receive layoffs when performance fails. CEOs exit with golden parachutes. Employees exit with cardboard boxes. So the next time a bank executive says, "We're committed to transparency," remember what transparency actually means in banking. It means telling the public only what is legally required, nothing more. And that's why collapses keep happening. The people who know the truth early have no incentive to reveal it. The people who suffer the consequences have no way to detect it. But you can detect something. You can detect the pattern. That's your power. And once you learn to recognize it, you will never look at banking headlines the same way again. Watch for sudden insider sales. Watch for CFOs leaving unexpectedly. Watch for risk officers resigning. Watch for overly optimistic earnings calls. Watch for rising interest rates squeezing regional banks. Watch for commercial real estate defaults creeping upward. These are the signs insiders act on. These are the signs CEOs quietly trade on. These are the signs employees never see until it's too late. And here's the most important piece of all. Collapses don't happen randomly. They happen mathematically, predictably, slowly at first, then all at once. And the insiders always move during the slow phase before the all-at-once part hits. Companies collapse from the inside long before the public ever knows. By the time the news reports the collapse, the insiders are already safe. By the time employees get the email, the damage is already done. By the time the doors lock and the website goes offline, the CEO is already on vacation. This is why you need to understand these patterns. Not to be afraid, but to be prepared. Not to panic, but to pay attention. Because the next collapse will look exactly the same in the beginning. Calm, quiet, comfortable, until one day the numbers stop adding up. Until one day the deposits start leaving. Until one day the CEO's trading plan activates. And once that happens, the countdown begins. You might wonder, is there any way to stop this? Any way to protect employees? Any way to prevent CEOs from cashing out before collapse? In theory, yes. In practice, no. Regulators could tighten the rules. They could limit insider trades during risky periods. They could force executives to hold their stock longer. But history shows something else. Whenever the rules tighten, the loopholes evolve. Whenever regulators close one door, insiders open another. Whenever employees think they're safe, the system shifts again. So the real solution is awareness. Not waiting for someone else to fix the problem. Not trusting executives to warn you. Not assuming the system will protect you. Because the system isn't designed to protect you. It's designed to protect them. And that's why this video exists. To show you what happens behind closed doors, to expose the patterns insiders hope you never notice, to prepare you before the next wave hits, because make no mistake, another wave is coming, another collapse, another series of insider sales, another group of employees blindsided, another CEO pretending to be shocked on television. The question isn't if, the question is when. So stay aware, stay informed, and subscribe to understand when the next financial shock hits, because the people who know early survive, and the people who don't become another tragic story. And if this video opened your eyes to a pattern you hadn't noticed before, share it. Share it with someone who trusts the system too much. Share it with someone who invests in their company's stock. Share it with someone who deserves to know how collapses really happen, because knowledge is the only protection employees have and the only thing CEOs hope you never gain, because at the end of the day, this story isn't about CEOs selling millions. It's about employees losing everything. And that will continue until enough people recognize what's happening in the shadows and refuse to be the last to know.